Hello there everyone, today's video is all about property tax. Now, especially the differences, an overview between the various differences in the tax treatment of having a buy-to-let property or a portfolio of properties in your individual name or as a limited company, or indeed if you have furnished holiday lets, because there are special tax breaks afforded to those. So I thought I'd do a video encapsulating all of that and get them all summarized, the various differences. So, starting off with interest relief. So here's the biggie. Here's the one that was restricted about 5 years ago. The government said, look, we don't want to give tax relief on the interest deduction. In fact, actually go back many years, like 2 decades ago, there used to be a case that you could get interest relief on your property that you lived in, your main residence relief. That all went out the window. Anyway, just as an aside there, Myras it was called. I remember that. But so over the years, the gradual trend basically is to give less generous tax relief on interest payments. Now, landlords, buy-to-let properties, you could have only historically got the relief up until a few years ago on the interest element only of the mortgage repayments, not the capital element. So tax relief on the interest. Then the government brought in about 2017. They said, oh no, we don't like that anymore. We're going to curtail that. We're going to restrict it. Gradually withdraw it over about 5 years so that right now, 21, 22, if you're doing that tax year, there is no tax relief for interest payments on those mortgages. Depending on the makeup of your other income, you can get a tax reducer of up to 20% of the interest, but often you may not be entitled to that depending on what else is in your income. But that default original position of full interest relief has gone. So that was valuable relief, 40, 45%, that's gone. If you've got a furnished holiday let, so furnished holiday let, short-term lettings, holiday cottages, that sort of thing, if it qualifies for the so-called FHL status, then that is more generous, particularly on the interest relief. So yes, you can get interest relief against your taxable profits as a individual that owns an FHL property. And what about limited company? Comparing all of these different arrangements. So if you're a limited company and you have a buy-to-let property or an FHL, again, within the corporate wrapper, there is no restriction on the interest relief. So only if you have individually held properties do you get the interest restriction. So next one, capital gains tax savings. So if you are a landlord and you own one or more buy-to-let properties in your own name, or say jointly with the spouse, when you come to sell the properties, they will be hit for income tax at 28%. 28% is the default position for capital gains tax on residential property. But if you are selling an FHL property, 10% tax, it qualifies for entrepreneurs relief or business asset disposal relief as it's now known. Entrepreneurs relief, 10%. So that's a heck of a difference. So 28% for a regular buy-to-let to just 10% if your property qualifies as an FHL. What if it's in the limited company? So capital gains tax, same sort of principle. Basically, the capital gain is the difference between what you bought for it and what you paid for it, and the company will pay corporation tax on the capital gain. So corporation tax currently low, 19%. So when you sell a property, 28% individual, 10% finished holiday let, 19% in limited company. Now you may say, what if you got an FHL in a limited company? It doesn't matter. There's no 10% afforded to companies on property sales. It's 19% corporation tax. What about other capital gains tax breaks though? What about holdover relief, rollover relief? So basically, when you sell assets, replace them, and you roll over the capital gain, you basically kick it in the long grass and defer it down the line. No such deferrals for individually held properties, but you do get those if you have FHLs. So let's say you sold an FHL, and not only is it taxed low at 10% anyway, but you could defer the capital gains tax by investing in another FHL. Can't do that with regular buy-to-lets. Limited company, what's this? Incorporation of a portfolio, right? So this is what a lot of landlords are trying to do, particularly because of this problem. Interest relief denied, all of a sudden portfolios becoming a lot more expensive. lot more costly because they're not getting the tax break. So they're saying, well, can we just incorporate our portfolio, shift everything that we've got here into a limited company? Now, the answer is yes and no. It depends, like many things in the tax world, predominantly on the size of your portfolio. If you have a large portfolio and you're running it as a trade, as a business, then in certain circumstances, when you sell or transfer the portfolio from yourself to the limited company, that would normally trigger a capital gain, but it can be deferred when you instead issue shares from a new limited company to yourself in consideration for that transfer. So incorporation relief is available to limited companies, but in circumstances. I've done separate videos on that. It's quite a specialist area. So moving on, VAT. VAT is never applicable on individual buy-to-let properties. It's always an exempt supply, is rent. We can't opt to tax like we can on certain commercial properties, or, there's never any zero rated like there is on new builds. A supply of rent, of residential rent, will always be exempt from VAT. So you don't have to worry about doing VAT returns as a landlord. However, FHLs, whilst they do have many tax advantages over regular buy-to-lets, one of the disadvantages is that you've got to charge VAT on those rents if you exceed more than 85,000, but like a hotel would. Hotels standard rated, they would charge VAT. If your FHL business is turning over more than 85 grand, then you have to start adding VAT to the rents. Now, of course, commercially, you've got to say, well, what are you going to do here? Because often your clients, the end users, are not businesses who can claim the VAT back. So if you start adding 20% to your rents, that's the client's going to suffer that. So you've got to ask yourself, well, will they kick off if you increase your prices 20% when you become VAT registered, or will you simply absorb that in your margin and have a lower margin and keep your price the same, but hand over a chunk of that to HMRC as VAT and you have less profits? But you might have no profits if all your customers disappear. So it's weighing that up, what to do at the point of getting VAT registered. It only applies to FHLs. In limited company, well, yes, if you had an FHL business in a limited company, the same would apply on the VAT implications and the turnover. So the next one is IHT savings, inheritance tax savings. Are there any IHT savings for having a buy-to-let portfolio? The answer is no. And for FHLs, maybe, but it's a high bar. So even though the government give better tax breaks for FHLs, and the reason they do that is because they deem it slightly risky, the fact that you could have a lot of unoccupied periods, off-season, it's a lot of short-term lets. It's unlike, say, a buy-to-let where you've got a tenant in for many years or a couple of years or whatever, it's more risky for void periods and commercially to have empty space. Hence, that's the sort of quid pro quo why the government give you better tax breaks generally on things like capital gains and interest relief on FHLs. But the paradox is, even though they treat an FHL like a trade for capital gains tax purposes, the same isn't true for inheritance tax purposes. And for IHT, the general rule is that even though FHL is deemed to be a business in certain regards of the tax world, again, in the UK tax code, there's no consistency generally across all the taxes. For inheritance tax, they say it's not treated as a business, it's not treated as a trade. However, there have been one or two cases in the tax tribunal where the taxpayer has won and argued, look, we are spending so much time in our FHL. It is not passive investment business where we just, throw in a bit of breakfast. We're doing so much more than that. It is a genuine business. We're doing it full time, everything else. And in those cases, IHT was deemed to be in play. But it's a very high bar to get IHT savings for FHLs. Doesn't apply to limited companies on the shares. There's no business property relief on those shares, so no IHT. So IHT, no breaks per se for residential portfolio, other than maybe on an FHL, but it's a very high bar. So next one is pension contributions. So if you were a buy-to-let landlord owning buy-to-lets in your individual name and you had no other income, you can't pay a pension contribution into your pension fund and get tax relief. because the rules say to make pension contributions as an individual, come on to corporates in a minute, as an individual, you have to have what they call enough relevant earnings to frank those contributions. And rental profits don't count as relevant earnings. A salary would, dividends don't, a salary would, and rental profits don't. So it's a no on that one. If you don't have, and depending on what the rest of your income is, but assuming you just have nothing but buy-to-let rental profits, you've got a few portfolios, you can't bang in a chunk of change into your pension to reduce the income tax burden on the buy-to-let property. Unlike, however, an FHL, where you can. So again, it's one of the tax benefits of having an FHL, that you want to reduce your tax bill on your furnished wholly let profits, put a few quid into a pension. You're allowed to do it. You're allowed to do it on an FHL. Okay. Company, well, yes, it's a different ballgame. It's a corporation tax play, not an income tax play. You put in a corporate contribution from your limited company into your personal pension pot, and that is deductible against the rental profits in the limited company. Saves tax at the corporation tax rate. So the next one is extra Sdlt. Now, unfortunately, there's Sdlt abound and all the different options. That is one of the things that the government has specifically come out with because they're not huge fans of buy-to-let landlords. Talk about distortion of the housing market and all that. But anyway, that aside, put the politics aside. But unfortunately, the tax law is in that says you got to suffer extra Sdlt. So if you've got more than one property, and the one being, say, your main residence, so even on your first buy-to-let property, you got to stump up extra Sdlt. There's a surcharge for having more than one property, and then every time you buy another property, that surcharge is in place. So that extra few percent on top of the regular percentage for Sdlt. So that applies to regular buy-to-lets, and it also applies to FHLs, and it also applies to limited companies. So whichever way you hold or buy your portfolio, your assets, your property assets, you've got to stump up extra Sdlt, unfortunately. The next tax to have a look at is capital allowances. So capital allowances, which is tax jargon for depreciation of assets. You get tax relief on capital allowances. So it's a deduction against your rental profits for the depreciation of certain assets. Now, what kind of assets? Now, if you've got buy-to-lets in your own name, the types of things that you can claim capital allowances for are things like equipment that you use in your business as a landlord. So let's say you bought a laptop to keep your rental records. You've bought an industrial carpet cleaner that you use to clean up after all the messy tenants. So all the kit that you buy to use in your business as a landlord, you claim capital allowances, which is tax deductions. Now, for FHLs, again, you can claim capital allowances, but it's more widely available because what else it encapsulates in FHLs are things like furnishings, white goods, all the things that you kit out the house with. So not that you're using as an asset as the landlord to help you run your business, but the stuff that you're kitting out the house with that you're renting out, you claim capital allowances. Now, as a regular buy-to-let landlord, that is called replacement of asset relief, and you cannot get the first acquisition of those types of goods as tax deductible. But when you replace them, then you get replacement asset relief. Now, basically, having this rule of capital allowances in FHLs means that's accelerated. So you get tax relief on the first acquisition of these things. Now, I've done separate videos on how to do some planning around that for individual buy-to-lets in terms of what you are actually acquiring from the vendor of the property, where you say, I'm going to give you a few quid for the furnishings, and then all of a sudden you're jumping into the first acquisition. But basically, capital allowances more generally available for FHLs. So yes, it's the same for the company, exactly the same as it would be if you got property or FHL status in the limited company. No change to the capital allowances rules per se for company. Again, it depends on the type of asset, FHL or not. And the last thing, just to compare and contrast, is losses. So if you have losses from your buy-to-let portfolio as an individual, you cannot set those losses off against your other income. So let's say you did have a couple of properties that are making a loss, particularly made a loss, say, because you got the restriction. You know, you don't get the interest relief, but you still could have a loss anyway. So any interest relief would have increased the loss. But you've got a loss, say, but you've also got a full-time job, and you'd say, oh, if only I could knock off the $5,000 of losses from my property against my 50 grand salary. Well, you cannot do that. But on the bright side, what you can do is carry that loss forward to the next year. Hopefully you've had a better year, you haven't spent as much on repairs and renewals, so you've got a bit of profit in the next year. But then to reduce the tax bill, then you've got these brought forward losses from the previous year, and you can carry these things forward indefinitely. The rules are that you lump all of the UK business together and treat it as one separate business. So you're not ring fencing losses and profits on individual properties. It's on a combined, what is your UK portfolio, and also a foreign portfolio. So let's say you had a property in Spain or Portugal that you're letting out, and let's say that property or properties were making a loss, your UK properties were making a gain. Again, the two are ring fenced, that it's segregated. You cannot use the losses on the Portuguese property to set off against the income of your UK portfolio. But again, you can carry them forward to hopefully set off against profits in the future of your foreign portfolio. So that is what you can do with losses. And also, actually, you can also carry forward any unused relief against finance. So any interest relief where you don't get any of the 20% credit as a tax reducer, again, you can carry that forward. So losses, valuable because they don't expire in year, they are available to carry forward. So for an FHL, it's exactly the same. There's no particular loss benefits for FHLs, and in a limited company, it's exactly the same. It's exactly the same. So a few of the various taxes similar across all the various ways of holding these properties and the types of properties. But for others, there are big differences. Particularly, that's the biggie, the interest relief being restricted as an individual, but not FHL and not limited company, and the capital gains tax as well. You sell those FHLs and just paying 10%, which is nearly just over a third, not much over a third of what you would pay if the property was not an FHL. So just an overview there on the various differences in the tax treatment, just summarised across between individually held portfolio, FHLs and limited companies. So hopefully you liked this video. If you did, please do remember to subscribe, and I'll see you soon.